So the stock market crash might just be getting started right now, but honestly, the market did run up a lot in the last couple months. So if we're going to get out of the market, we could still get out at a very good time right now. So in this video, I'm going to break down if we should hold, if we should sell, what Donald Trump just said and why the market's going down, and what this really means for our portfolios. I'm going to cover everything in a very simple way, and I'm actually going to show you inside of this portfolio to show you exactly how I'm going to capitalize on this, to show you how if the market goes down, we're probably going to make some money, and if the market goes up, we're obviously going to make some money too. All right, so let's dive into what our boy Donnie T just said. Let me get myself out of the way here. And you could see that Trump threatens massive tariff hike on China over rare earth dispute. So basically what's happening is China is potentially putting on tariffs or restrictions on rare earth exports that come out of China because China controls so much of that market. Trump feels like China is not negotiating in good faith and giving us good deals. So the thing that Trump likes to do is he likes to send out a tweet telling us we're going to slap a big tariff on China. And everybody's freaking out that this is going to be like the next Liberation Day thing. And if we go look at the chart of what actually happened for Liberation Day, this is for the S&P 500. You could see that the market fell roughly 18.7% on that dip right there. And the sharp dip here was actually on Liberation Day. And you could see like in the days after that, it fell like 12%, which is pretty crazy. But look at the rally that we had since Liberation Day, since that April 8th bottom. The market is up 32% from that dip. Massive rally. And you could see the little dip right here is what's happening right now. I'll go to a 5-day chart. You could obviously see we kind of fell off a cliff right here. But the thing that everybody wants to know is this. The market ran up a lot. Is it time to take profits, or do we just let our winnings ride and just keep riding this hype train going higher and higher and higher? Because AI is great, profits are great, revenue is great, companies are growing great, guidance is great. The show goes on. But do we sell and take profits, or do we just let it ride? That is the question that we're going to answer in this video right here. So I just want to show you what's going on with my account. You can see that I'm down roughly $26,000, now 27.8 at the time of recording this video. Again, look at the growth of this account, basically from $450,000 just a couple years ago to now over 1.2 million, and it's up 171% in 2 years. I'm not sitting here bragging and you're probably like, Brandon, I don't care about your account. Show me what trade to make, and I'm going to show you in 1 second here. But the point that I'm getting at is this. The market made a big move. The market moved up a lot. Did the earnings growth go up as much as what the market did? The answer is no. Like the S&P 500 in 5 years, it's up 90%, and the Nasdaq's going to be up even more than that. Did earnings per share grow as fast as what the actual index went up? The answer is no. So yes, giving a little bit back and taking a little bit of a dip, sure, that's going to be okay. But is the market going to keep going higher, or is the market going to take a dip? And we do have to start on this chart right here. And I know that we've talked about it before, but I want to kind of explain it in a little bit different of a way. And if you're new to this channel, I talk about fundamental analysis a lot. I talk about just keeping things simple and how we make money. I'm here to make money. You're here to make money. So I think this is a really important chart to look at here. So this goes back many decades, showing you what the current price earnings ratio level is on the S&P 500 versus the 10-year returns after that. So price earnings ratio level right now is roughly 23 to 24. What are the future expected returns supposed to be for the market for the 10 years coming? You can see that where the green line is, it's actually not there. This is implying like 22-ish, or actually around right here for 24. And it's basically saying that the future expected returns for the market annualized, so 10 years in a row, average it together, what do we think it's going to do? It's basically expected to do nothing / down a couple percent. So we're talking about a 10-year stretch of time right here that the market is really expected to do nothing, simply because valuation levels are on the high side. And I was actually just sending out a tweet today earlier on X talking about how valuations don't matter until they do. And I realized that people that are buying Palantir and AMD and Nvidia and Tesla and all the hot stocks, sure, you made a crap ton of money and I'm happy for you, and I made a crap ton of money on it too. But when valuations get stretched, you're kind of playing against your luck, because anytime a negative catalyst comes out, the market is going to correct, and that stock is going to correct much more when the valuation's on the high side versus on the low side. So the name of the game is to buy something when it's cheap, let it run up, capture the majority of the move that you're expecting to come, sell it when it's expensive, and then just take that capital and just go reallocate it to something that's a little bit cheaper. That is the name of the game. But the problem with most investors is they like to buy in when things are hot, they like to sell out when things are cheap, and that's why they buy high and they sell low and they lose money. You have to flip the script on that. You don't want to be like the herd on this rally that's happening right now. I see so many people that come into my Discord that haven't finished my course yet, or just people on X sending me DMs saying, hey, I want to do a HELOC on my house. I want to go buy calls on this stock. Should I go do that? And I'm like, what's your thesis? Why do you want to go buy that stock? And they're simply just like, because the share price is going up and my friends are making a lot of money and I see all these people on X posting about it. And I'm like, you're just like everybody else. You're just like the herd mentality of just following the trend of buying when things are going up and selling when things are going down. You have to flip that and understand this chart right here that yes, fundamentals, they haven't mattered that much the last couple years, but eventually they will. Eventually stocks will be put on a scale and they will be weighed for how much they're truly worth. Right now the trend is up. Everybody in the last couple years in the stock market is a genius, and I realize that. I mean, you could have bought really anything because everything is going up in the market right now. You would have done just fine. And those people go make a Discord, they go make a course, and you go follow them, and it's like, oh yeah, they're great. It's the best thing since sliced bread. But they haven't ever experienced a dip. Like the dip that happened right here in 2022 where the S&P is down like 25%. This was like the end of the world to many people. The Liberation Day tariff stuff that happened right here, that was like the end of the world to many people too. But you have to understand that these dips are not the end of the world. These dips are opportunity. But also when the market's hot like it was right here, hot like it was right here, and again, hot like it is right now, that might be the time to take profits. That might be the time to sell. And if we look at this chart right here, this is really going to put things in color for you a little bit more, just to show you how expensive the market really is. So the red line corresponds to the S&P 500 price earnings ratio level that it's at. So the blue line is a PE ratio level, but the red line shows you what the actual index is at. So roughly 24 for the price earnings ratio level right now. And again, if we just go back to this chart, what do we do if we're at 24 in this category right here? The future expected returns for the market pretty much suck. Now, what do we think the market's going to do? Well, the two main things that drive the market higher is going to be earnings per share growth and price earnings ratio level expansion. How much more can the price earnings ratio level really go up? I mean, this chart goes all the way back to 1985. How much more can it go? The dot-com crash, it was like 24 to 25. We're pretty much at 24 right now. So sure, we could go from 24 to 25 and call it good. But at the end of the day, we need earnings per share to keep growing. And it is growing right now. It's growing pretty strong, actually. So as long as that keeps growing, the show's probably going to keep going on. But I don't like to put all my eggs in one basket of I need earnings per share to keep going up to keep my portfolio going up. I like to allocate to different companies and different ETFs. So in the event that the market were to fall, I could capitalize and I'm still going to make money. So let me show you inside of my Charles Schwab account like I promised to do, just to show you what's really going on. And I do have a couple different accounts in this account of Charles Schwab, but we're going to go into my main brokerage first and we'll see what's going on here. All right, so you can see the core of my portfolio is typically in VOO and Triple Q, which it usually always is because that is the base portfolio. And it's so critical to have that established because when I go to sell options, I use this to secure the plays that I sell. I don't secure it with cash because if you're selling put options, for example, you're bullish on a company, why would you want to have a big amount of cash right here just sitting there doing nothing? You wouldn't really want to do that. So let me just explain what's going on in here. So VO Triple Q we talked about. Tesla I have, cost basis of $149 a share, now over $400. I'm going to hold that for a while now. I did trim some Tesla recently because it was becoming too much in my portfolio. This is roughly 8% of this account. I didn't want to get too overweight on that, so I did trim a little bit. United Health was the table pounder play that we were talking about, on X and Discord for a while now. We made the play. We're up some money on it. We're up 26,000 here, 25,000 here, 10,000 here, 8,000 here. This is like a $60,000, $70,000 play right now. So that's looking good. I did start to sell some covered calls on the base portfolio on Triple Q. I do own 600 shares, so I sold 6 contracts right here, and I'm up 54% on those calls that I sold. I only picked up $1,100 in premium, but again, when the market's falling down and when you expect things to take a little bit of a breather, you could generate a little bit of cash flow by selling covered calls on your shares or your base portfolio. And I'll probably end up selling some more covered calls on Tesla here pretty soon, but I want to wait and see what happens when earnings come out to feel confident doing that because their Q3 delivery numbers were pretty strong and their earnings per share is probably going to come out pretty strong too. But the stock also ran up a lot going into this report, so there's a good chance it's still going to be like a buy the rumor, sell the news type deal. So we'll see what I end up doing with Tesla. Now, Open and ARM, these trades that I have right here, I have a Discord bot. It's called TradyTix, and it basically uses AI to analyze thousands of different companies and scenarios and metrics and sends out high probability of success trades. And overall, it's been working really, really, really good. And I realize these ones are down right now. The ones that I made money on, I closed out. But you could see that I'm doing teeny, 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 tiny parts of my portfolio. Like we're talking a couple $100 right here because we're still testing it and we're still trying to gain trust in it. And as it keeps sending out more bangers and as it keeps, we build more trust in it, we'll do bigger plays to follow it. But for now, I'm just really just doing this as a test. But overall, it's been pretty good. So these plays right here, this is not like the strategy that I teach in my course. This is just like total speculation and gambling right here. I did recently sell some puts on Amazon and Meta because I feel like both are trading below intrinsic value. Strong growth, strong revenue growth, strong earnings per share growth, and they're kind of out of favor right now. And when things are out of favor, people are more willing to buy downside protection, which is buying a put option. So when people are willing to pay more for a put option than what they're actually worth, I'm willing to sell them put options. So I sold 10 puts on Amazon and 2 puts on Meta. I did less on Meta because obviously the share price is higher and the premium, it's going to be way out of whack if I just do 10 and 10. So I collected $21,000 in premium for selling the Amazon put, and I collected $12,866 for selling the Meta put. Now, what I did with this cash, which I still have a little bit of cash right here that I'll do something with, I took the cash and I bought BLV. Now, BLV is something that I like for multiple reasons. Number one, I think the market's overvalued. As we talked about on this chart right here, the market's expensive. I'm just going to leave myself in a way there because I already explained it. But the market's hot. I don't claim I know exactly where the top is, but what I do know is that future expected returns are probably going to be less than what, it was in the last couple years. So why not park a little bit of capital in BLV, collect roughly a 5% dividend yield, and on top of that, if interest rates happen to fall for really whatever reason, BLV is going to appreciate in share price. So this is kind of like a hedge against the economy taking a crap, the labor market taking a crap, interest rates just naturally falling, Jerome Powell getting fired, and someone goes into Fed that just cuts rates to 1% like Trump really wants. If any of those scenarios play out, the share price of BLV is going to go up because BLV tracks the price of bonds, not the yield of the bond. So if yields fall, the price goes up. They move inverse from each other. So I do think that BLV is a good place to park capital right now. And this is 10% of this Schwab account. But my other Schwab account, I have a couple $100,000 in BLV and VCLT also, which are basically going to do the same thing. If yields fall for whatever reason, the share price will probably go up, and you're still going to capture your yield right here. So at the end of the day, this is what we got. The market ran up a lot. Valuations are a little bit stretched. Trump did a negative catalyst to push the market down. And honestly, this little dip is justified. Do I know exactly where the top or the bottom of the market's going to be? No. But if you were to force me to tell you, hey, Brandon, what do you think the market's going to do? I do think that the market for the next year-ish is really going to do nothing. I think we're going to have a lot of downside and upside volatility, but I don't think the market's really going to make that big of a move because it already made a huge move and valuations are already stretched. I think a lot of this AI stuff is already priced into the market right now, and it's kind of just like, what's the next big thing? But it's all kind of priced in. So if you're buying options, I think it's a pretty tough time to do that right now. So that's why I like to sell options, because selling options, you don't need as much things to go right. You could just sell an option below the money, give yourself a good expiration date, like a year out or whatever you want to do. And you have a lot of flexibility to make money on that. So you could generate a lot of cash flow in your portfolio. Selling puts on things you feel like are still kind of cheap, selling calls on things that you feel like are kind of expensive. That's kind of like the name of the game right now. So I'm going to wrap up this video here. If you got a lot of value from it, be sure to like and subscribe. Watch this video right here. It's a little bit more into options and how I do it. I'll see you guys there.